This article will explore how to form a single-member LLC, which is the safest way to personalize your business while avoiding tax penalties. If you're a small business owner just starting out and are looking for ways to protect yourself from taxes, consider organizing as a one-person LLC or a multi-member LLC if you are getting into a partnership with someone. Luckily for you, Real Talker, in this video, we will discuss how you should be using the tax law to your advantage as an LLC. You will learn what is the best way to pay yourself as an LLC. Let's dive in. The first thing that you need to understand about the single-member LLC is the bits and pieces of the disregarded entity. Essentially, a disregarded entity is no different than a degree in business. Anyone who starts up their own business as a disregarded entity will have established a sole proprietor business. However, you can now separate the liability from yourself. You no longer have just your social security number to use, but instead an EIN that you can utilize. The bank may take your EIN or employer identification number to a local bank where you can open personal banking accounts, check accounts, savings accounts, and even credit card accounts. Now let's take a look at how a single-member LLC pays taxes on its income. Very simple for you. To understand this, we'll break it down for you in this video. This is how to enter your own LLC, which has only one member. To start, you will draw a line down the center of the page. Put your LLC on the left side and draw yourself, as well as your business on the right. We legally separated our business from our personal assets and liabilities, which means there is no longer any liability associated with our company. If we have a lawsuit, we don't need to file as a sole proprietor because the company is now separate. Let's say we have an online candle business and make $100,000 in 2021. Well, let's make sure that it's accepted the right way first. If you run a limited liability company or LLC, you need to adhere to the rules of certain legal forms to avoid penalties. As a one-member LLC, the government has given you an important number, your EIN number. It is easily worth more than any other ID for your business, as it represents its true identity. This number is important in multiple ways, whether you're a consumer or someone hoping to grow their business. It's the number that you have when banking online, and it can be used as proof of financial responsibility when applying for financing, among other things. To get an EIN number, you need to go take it to a bank, talk to them about opening business accounts, and talk to them about how they can deposit the $100,000. Once we have the bank account and single number LLC, this business is able to accept payments of $100,000. But now the next question becomes, how do we pay ourselves if we have moved money into our personal accounts and ADP or Carla and Associates is run just to keep it running? We have taken what's called a distribution from the company so that then we have more autonomy in financial decisions. The term distribution simply means that entities distribute money, like we might distribute $20,000 to ourselves. This doesn't mean that the business's finances will be negatively impacted because of it. No deductions are made. And part of the reason why our business doesn't incur a deduction when we're a single-member LLC is because taking away the check or just transferring money to us or doing it ourselves and also mowing. The reason why we as business owners don't get a deduction for paying ourselves as a single-member LLC is because we are only paying ourselves and being taxed as an S-Corporation. Being a simple single-member LLC, you are in effect just a shareholder. You can earn income as a shareholder or pay your employees by receiving a deduction. You can also take income to yourself or the other members of your group. But when you pay yourself, you don't get any type of deduction. This way, some of my single-member LLC clients go into their businesses incorrectly because they expect to profit. Some single-member LLC clients are also in this boat because they will start to invest in their business and they won't receive any tax breaks. With no deduction, The single-member LLCs can lose out on a lot of money when they pay themselves. Suddenly, they find themselves in a spot where they want to start paying themselves, but they are not getting an extra deduction every single time they pay off their credit card. They then come to their tax guy and ask, "Is there anything I could have done to reduce my tax bill?" And then later find out that they should have switched over to an S-Corp in order to claim this deduction for paying themselves on the tax return. So let's talk a little bit more about how an LLC can switch over to an S-Corp to pay themselves out of their company. If they're an LLC, in order for them to switch over to an S-Corp, they'll need to complete a Form 2553 and Form 8832. This is how to transition an LLC into an S-Corporation. But one thing that you need to understand about the S-Corp is that they have a lot of rules. One of the rules at S-Corp is that you must pay yourself a reasonable salary. A salary is the money paid to an employee in a regular, consistent job. In any given year, it's important to determine the factors associated with a reasonable salary. The Internal Revenue Service requires that employees pay taxes on the income that they earn and then file the tax returns for them at the end of the tax year. If you think about a job that you have held in the past, think about any of your past jobs. Whether it was working for 7-Eleven, whether it was being a bellhop, whether it was being an Uber or Lyft driver. Your pay rate depended on what job you did. The earnings were based on what you were doing. But if you are involved in a business and money making, it's possible for your business to be extravagant. In this case, you may have an immense YouTube star. Some other examples of these types of businesses would include being behind the camera and just selling yourself online. So you have to try to determine a reasonable level of compensation for yourself based on the amount that you are earning. However, this should not just be based on the amount of money that is coming in, because there has to be taxes, and when you factor those expenses into the equation, there needs to also be a consideration of your net income after all expenses. If you earn a great income but spend a lot, it's hard to maintain your lifestyle and make a good living. For people in this predicament, they never really find themselves making a great wage. So let's say you made $300,000 in your business, and then after all expenses, you were left with $200,000. Well, even though you grossed $300,000, this was the gross operating income for your business. With a $100,000 taxable income, you can only make about $10,000 in net income per year. The employee E owns shares of the business and makes a salary from there. She needs to take a reasonable amount from her business as owner, so she has an annual salary they deduct taxes on. And with reasonable compensation, it's not all the money made. It's a percentage of the money that was made. When you think about companies like Nike, Google, Microsoft, they're not dumping out all the money that they have in their account to their employees and give them a portion of it as a fair compensation for their work. By setting an internal salary that covers your expenses, you can avoid the IRS and tax accountant problems. You can set evaluations based on what they feel is fair for everyone involved in the company. The difficulty is that you need to decide on a rate with a partner based on your net income. The basic rule of thumb our team uses is that you should never take less than 30% of their income from your business. Keeping in mind that a business has to take $30,000 from the $100,000 before taxes are calculated. Then, if the business were to make it to that point, most of the deductions should be applied to personal taxation. This is where you will have taxes and different payroll deductions come into play when a business owner starts making more than $20,000 to $30,000. When you start to make $50,000 to $60,000 or more, this becomes very powerful for you because these payroll deductions are taken out for you automatically for taxation purposes. Now you only pay Social Security and Medicare taxes on what you paid yourself. So we are paying ourselves $30,000 and will also get to keep $100,000. We are going to pay 7.65% in Social Security and Medicare taxes. while not paying the self-employed tax of 15.3% on that $30,000 or the $100,000 from our taxable income. The other $70K, my business income, will now flow into my personal tax returns instead of being taxed as it would have been if I was a C corporation. When it flows over to my personal tax return, that's when it becomes subject to the QBI deduction. What QBI deduction stands for is Qualified Business Income Deduction. This means that if you make an S corporation or LLC and work to grow the company, you will not have to pay yourself as much in salary. There is a 20% deduction on any business income down to your personal self-employed wages from your qualified business income. If you already made $30,000 without being taxed on that amount and could take a further 20% deduction off of your total income, then you would have saved yourself $14,000 in taxes. Now you get a total of $56,000 in tax deductions this year. The first $56,000 is taxes that you paid personally, and the rest would be subject to federal and state taxes. Your expenses are going to be taxed too, with $30,000 being taxed by the FICA and state governments. In this scenario though, if you had a total net income of $100,000 and paid $30,000, then subject to 7.65% FICA federal and state taxes, you would pay more in tax than if your income was only $100,000. But the LLC tax rate means it is subject to self-employment taxes for a single member. So if you are ever hoping to deduct your employment costs, you can't, because you don't give yourself an income on your business. However, once you employ the provider or when you become a single member LLC, your self-employment tax will go to 15.3%. If you're in an LLC, you may start to feel the downsides of being in an LLC. If you don't know when to switch from your LLC to a S corporation, below is an example of what it would look like if you were to personalize your LLC with $100,000. The first thing I want to focus on is that, unsurprisingly, revenues under the self-employment tax, which is 15.3% of the gross amount, plus Social Security and Medicare taxes before, are subject to the taxation rate. On top of that, there is FICA and Social Security taxes that are levied on self-employed workers. For example, your 15% tax bracket. Okay, now 15% of $100,000 times 100 gives us $15,000, and then just subtracting the expenses from it is going to give you $84,700. This means that you will probably be in the 24% tax bracket after all these calculations. Singles who have a taxable income of $18,000 will experience an additional $700 in state tax. For singles in California with taxable income of $18,000, their total taxes come to about $7,100. Let's just say $15,300. So you've already paid out of pocket $18,000 in federal taxes, and then the state of California will charge you another $7,000. You had to pay too much taxes and have to incorporate your single member LLC into an S corporation because you didn't do it on time. Then that person who made $100,000 got a $30,000 deduction from his taxable income because he understood the reasonable compensation of his employer. Instead of paying 25% for Social Security and Medicare, Trump only paid 7.65%, a spike up. He then received the QBI deduction and received the 20% qualified business deduction on what was left after taxes earnings. With that example, you can see how this puts the brackets into perspective. I will do the math for you right now. So let's break this down. If we have $56,000 plus $30,000, that's going to put us at about $86,000 into the 24% tax bracket. Estimating an S corporation's taxes in California requires factoring in the self-employment tax. In the state of California, This tax ranges from about 8.5% to about 9%. The difference between the total cost of operating as an S corporation and a single member LLC is about $7,568. If a business owner operates as an individual, he or she pays another $7,568 as employment tax. S-Corps can now be paid by owning the company. When a straight shooter has ownership, they get to take distributions of their earnings. This means they only have to run payroll once a year, which means if they want to stop the audit and monthly pay stubs like traditional employees, they become a hostess owner. You can also budget your finances and pay a one-time payroll at the end of the year when you know what your true net income is. With the help of budgeting your finances, you can get a better financial position as well as less taxes. Tax planning can help you with this, and with machine learning, there are some programs that analyze your data to find the best deals for you without having to touch the government. That's it for this video, Real Talker. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon.